Hey guys, welcome to the channel and welcome back to another video. On today's video, guys, first of all, I appreciate you guys being here. On today's video, we're going to be talking about the fact that the Fed just dropped the mic, so to speak, right? What's next for us as investors, retail investors, and what's next for our money, right? That's kind of the conversation we want to have today. If you're new to my lives here, I'm on YouTube. I'm also transmitting over on LinkedIn and, you name it, X or Twitter, Facebook, our private Facebook group, Smart Money Bureau Facebook group. So we're in a lot of different places right now. So if you're new to what we do, guys, we go on here live a couple of times, 2 to 3 times a week. And today we're going to talk about the big news in the U.S. economy. If you can hear me, give me a thumbs up and let me know you can hear me okay, guys. Very important news for American consumers, right? Those of us that are regular retail investors, very important news that came out here just a few hours ago. And that's why I wanted to jump on here and have this conversation. Usually we come on here on a Thursday. Today is a Wednesday, but I didn't want to let today go by without just addressing this with you guys about what happened today in terms of the Fed and what they decided, right? Of course, I always have to finish up my own personal 9-to-5 job before I can come over here and have this conversation with you guys during the week. So here I am. If you're new to hanging out with us, guys, we talk about money management. We talk about personal finances, the U.S. economy and how it affects us. We talk about investing our money and growing our money, whether it's index funds, stock market, ETFs. We talk about how to save our money. We talk about a lot of different things here on this channel, guys. Let me know you can hear me. Give me a thumbs up, and that'd be great, guys. I really appreciate it. Let's see where we are here. Hey, thanks a lot, Asiatic Soldier. Good to have you. Looks like you're checking in from New Jersey. Let's see here. So, again, guys, give me that thumbs up, making sure my audio is okay and that you can hear me all right. Test, test. All right, so let's kind of jump into it, guys. Let's see here. Just looking around, bear with me here, making sure that I can got everything rocking and rolling. All right, appreciate it, Chris and Steve. All right, so the Federal Reserve, guys, let's just jump right into it. The Federal Reserve has a dual mandate, right? This is what they talk about and preach about, and every time you listen to a conference that Chair Jerome Powell has, he talks about a dual mandate that the Federal Reserve likes to have and wants to keep, and is part of their policy. That's one, keeping prices stable. That's the inflation. And two, is achieving what they call maximum employment. Now, maximum employment doesn't mean they want everybody working, right? Maximum employment just means that they want to have enough folks working so that the actual economy is going to be working right. So that's what they mean by maximum employment. Chair Powell could have walked in today to today's press conference. I listened to it while I was working. I listened to what he said. And he really could have walked into today's press conference and said 2 things and dropped the mic and left, right? He could have said that, hey, guys, the 6-month core PCE is down below 2% at 1.9%, under our 2% target that we've been trying to get at for the last couple of years. So that's prices being stable, right? He could have did that because that's the first part of their mandate, is to stabilize prices. Core PCE only being at 1.9%. is lower in the last 6 months. The 3-month mark and the 6-month mark, the core PCE has been under the 2%, or near or under the 2% that they mandate, right, in their dual mandate. But he also could have said, number 2, guys, for 26 straight months, the unemployment rate has been under 4%. Could have checked that box also. He could have just walked in and dropped the mic and walked right back out, right? Because the Federal Reserve is really, they don't want to come out and say it just yet, but the Federal Reserve's policy of increasing the federal funds rate has worked. And it's worked not because they did it, but it's kind of worked in conjunction with a very, very strong economy. So he could have walked in, dropped the mic, and walked right back out, right? Because pretty much now we're in what's looks like, for the most part, what they call a soft landing, right? A soft landing where unemployment doesn't go way up, and prices come back down and stabilize, what they call stabilizing, right? So he could have did all that, dropped the mic and left. Now, of course, he didn't do that today, of course, right? But he definitely could have, okay? Now, I want you to notice something, guys, and I don't know if you listen to these press conferences that the Federal Reserve does every time they have a meeting, but when they get done with the meeting, he gives a 5-minute speech and then addresses questions or answers questions. But what I noticed today when I was listening to him as I was working, I was listening to him talk, is that the Fed Chair Powell sounded kind of timid, right? He didn't sound as strong and confident about the moves that the Fed was making like he had been sounding before. And I think it's because part of that is because they're kind of in limbo right now, right? They're kind of waiting around right now, not quite sure. If you listen to the same press conference 6 months ago, he was pretty hard, fast, and pretty stout about, yes, we're going to do this and the Fed is going to do this. But today it was kind of like, I wasn't quite sure, right? His tenor kind of changed when he addressed the press, right? So I noticed that, when markets are strong and there's much more clear evidence that things were bad, markets weren't so strong and wasn't clear evidence that things were bad, the Fed chair sounded a little less confident. Today, or he sounded more confident in what they were doing. Today, he sounded less confident, right? His language was sort of timid and weak and unsure. So the Fed seemed like they were not quite sure about the balancing act, right? If you want to know exactly what the role of the Federal Reserve is, guys, in America, if you're curious, you're not quite sure what the Fed does or who they are, all you got to do is really study the last 4 years here in the American economy, right? The Fed is not perfect, obviously, right, in terms of their quantitative easing and quantitative tightening, QE, QT policies, and how they handle their balance sheet, right? We know, let me just give you a little background about what's happening with the federal funds rate. How the Fed during the pandemic, they added the purchasing of bonds to their balance sheet, right? The Fed has a balance sheet just like any other business. So they added the purchasing of those bonds to their balance sheet. And they, printed money and took that money and they went out and they bought bonds, right? They bought bonds with the money that was printed, right? Which added to their balance sheet, added assets to their balance sheet. And at the same time, that flooded the U.S. economy with more and more money, right? Along with all the stimulus checks that we had that we were going to spend and so forth, because they wanted to stimulate the economy, right? And so more money was put in the hands of people. People had more money to spend. Inflation went up because there was so much liquidity. They call that when there's a ton of money that's pushed into the markets, that's called liquidity, right? All that liquidity and money that was put out there, increased demand, and the ability to pay for demand was there. And so inflation ultimately went up because high demand usually results in higher inflation, prices going up faster. So for the last 18 months or so, the Fed has been trying to pull that back, right? Inflation peaked, I think, the summer of 2022 when CPI headline inflation went over 9%, right? But the Fed's been trying to sort of pull that back by raising these Fed funds rate from almost down to zero three or four years ago up to about between 5.25% and 5.5%. So the Fed funds rate, just so you know, is the rate that commercial banks charge one another for overnight lending to each other. And when that went up to 5.25%, 5.5%, that meant our rates for short-term interest loans from banks and lending institutions also went up. Because when the Fed funds rate goes up and the banks have to charge each other more for money that's being loaned and borrowed to one another, then they pass that cost on to us when we go and spend and swipe something with our credit card. That's a short-term rate. Or it might go on to when we go get an auto loan. When we get an auto loan from a bank. So that's going to be increased also because that's a short-term loan. So all those things have gone up, right? The cost to borrow money has gone up. So what normally happens is we slow down our spending when this happens, right? And that brings demand down, and then it lowers the rate at which prices increase, also known as inflation. All that said, all that in the background, that's what the Fed has been attempting to do over the last year and a half or so. So now the goal of the Fed was to do all that and at the same time keep the GDP, hopefully the GDP, right? The way we measure how strong the economy is, keep that strong. And so if that didn't stay strong, if the GDP goes down more than 2 straight quarters in a row, typically that's a textbook version of a recession, right? So the Fed had all this on their mind that they were doing. And at the same time, they wanted to make sure employment, the unemployment rate stayed low, right? So all that was happening in the background. The Fed wanted to do all that while keeping a fairly strong economy and making the prices not increase as fast as they had been, inflation. So the last 4 years, in my opinion, guys, has really been like a master class on how the Federal Reserve operates in terms of policy, especially quantitative easing, quantitative tightening. I'm not going to dig into all that. But so now basically we're looking at a soft landing that the Fed wanted, right? The Fed decided today to not increase the Fed funds rate and to not lower the Fed funds rate or cut rates, right? So before I go further, guys, let me just tell you, if you're on YouTube, smash the like button for me, guys. Be sure to smash the like button. Be sure to subscribe if you're not already a subscriber to this channel. And also don't forget to share the video with someone as well. All right. I got some free stuff, by the way, down in the description box, by the way, guys. Glad you're here. Good to have you here. Dale Young, Steve, good to have you here. RC, Boynton Beach checking in. Good to have you as always. Kathy from Arizona, good to have you guys. Let's see here. Powell does not care about the market. Your 401k. Yeah. Feel free to chat away, guys. I do check out the chats a little bit as we talk here, but I just want to kind of give you that rundown on what's led up to right now where we are. You know, by the way, let's talk a little bit about inflation just real quick. So you always see the CPI or headline inflation, which is, I think, hovering around 3.4% right now, right? The latest numbers just came out about that. But just reported also a couple of days ago, and this probably made a big difference in the Fed's decision to not raise or lower rates today, was the fact that the core PCE numbers came out, right? Core PCE numbers clocked in at a nice outstanding low of 2.9%, right? Something to make the Fed feel good, right? All the stuff we've been doing over the last 2 years, 3 years. Now we're finally seeing the core PCE going down, right? Core PCE inflation dipped to 2.9%, which is the first time, I think I read, the first time that the core PCE has been below 3% since about March of 2021. That's 3 years, guys. So that's basically saying that inflation is going down right now. If you check out the 3-month chart and the 6-month chart of the core PCE, not the yearly chart, right? The yearly chart, right, you know, year over year 2.9. But if you look at the last 3 months and 6 months, core PCE is down below the 2% mark at the 1.9% mark, right? So very, very impressive, right? What the Fed has been doing, and there's been a lot of lag time, what they call lag time, because it takes a while for the policies that the Fed puts in place, like a rate cuts or rate hikes. It takes a while for that to actually manifest itself in real time, right? They call that lag time. So important inflation gauge, right? PCE, showing that the rate that prices are increasing has cooled off significantly to where it was just a year and a half ago or so, right? So that, again, lowest it's been since core PCE. We're talking core, not CPI. Core PCE, the lowest it's been in almost 3 years or so. So yes, the Fed will have sort of a green light, I think, to start cutting interest rates, the Fed funds rate, down from the 5.25 to 5.5. I think a little bit later in this year, right? Of course, we know that overall for core PCE, they're targeting, again, year over year, 2.9 right now. They're targeting a 2% annual inflation rate for core PCE. Now, when the Fed wants you to stop spending, they raise the Fed funds rate. They raise that rate to make it more expensive for you to borrow money. When the Fed wants you to stop spending, when the Fed wants you to go out and spend more money, they cut that Fed funds rate and they lower it, right? Which means money becomes cheaper to borrow, right? Just want to kind of throw that out at you. So they kind of got us on a string, so to speak, right? I mean, to an extent, right? That's how they kind of are able to kind of manage or maneuver their policy. So, what does this mean for us? Is it really good news? Can be, because inflation is down. But let me pause that optimism just for a second because of housing, guys. In the U.S. economy right now, yes, inflation is down. Core PCE is down. CPI is down too. But the housing market, and we all know housing, for example, what we call housing inflation, is still increasing at an astronomical rate, right? If you understand what I'm saying about housing, you'll understand that housing is still expensive in terms of rents for a lot of people that may be looking to move, right? In a lot of cities in America, not every city, but a lot of cities, right? We haven't seen the housing piece to core PCE. Core PCE includes housing, right? Housing inflation is still red hot all throughout the country, or most places in the country, right? Hasn't really cooled off like the rest of inflation, right? Just something to think about, guys. I mean, I think I read 5.7% for an annualized inflation, housing inflation year over year, 5.7%, right? And that when we talk about housing inflation, we're talking about tenant occupied dwellings. We're talking about, what's the other thing we're talking about? We're talking about rents. We're talking about, everything in terms of rents, right? And it's actually the housing piece of the core PCE inflation is actually the largest component of the core PCE inflation. So when we say core PCE inflation in the last 6 months is at 1.9%, right? Last 3 months or 6 months, 1.9%. That includes 5.7% of housing, which makes up the bulk of core PCE. If you take out housing from the core PCE, the rest of inflation is probably, much less than 1.9%. So good on one hand for overall inflation, right? But on the other hand, the housing inflation is still pretty high, guys, right? Let me know in the comments, guys, if you're on YouTube and not on YouTube, even if you're not on YouTube, let me know in the comments, do you know somebody who's been looking for a place to rent in the past year and a half, and they've experienced really, really high rental rates, right? See, the rental rates, or like I said, rental inflation hasn't really gone down with the rest of inflation, right? So it's gone down a little bit, but it's still much higher than it should be. And I think most people, if you live in a larger city, guys, you've experienced, or someone who's experienced sort of large, exorbitant prices for little bitty places to rent, right? Tiny little homes in a small part of town. And you're saying, well, why in the world are they charging that much for rent, right? I know I've seen it where I'm at. So I know several people have been looking for a place to rent in the last year and a half or so. And they're saying, man, this is ridiculous when you look at all of how much these prices are for what you're getting to rent. So just something to think about, guys. And I know several of you have. Yeah, some people chimed in and said several, yes. So rent is still high. Now, so with rent inflation still being high, yeah, we're happy that the core PCE is down to 2.9% year over year. We're happy as citizens that core PC or CPI inflation is down as well, 3.4%. But we're still a little bit funny about the housing piece, right? Just something to think about. So we got word today, and I want to go back to this, guys. And by the way, hit the like button, share the video, check the description box below. I got a bunch of free stuff down there for you guys. Remember, we come on here and go live at least, and I think this is the first time we're actually on LinkedIn live. So that's cool. Good to have you guys. If you're checking in from LinkedIn, good to have you. Glad you're here. We do this at Smart Money Bro on YouTube at least 2 to 3 times a week. Thursdays at 4:30 p.m. Central Time. Saturdays, 11 a.m. Central Time, and we talk about the U.S. economy. We talk about money management. We talk about the foundation of investing, right? Whether it's individual stocks, ETFs, index funds, whatever they may be, REITs, whatever it may be. We talk about all that. We talk about ways to grow your money, and we try to hit all things money at Smart Money Bro on YouTube. So if this is your first time being here, please consider going over to YouTube and subscribing to the channel as always, guys. Let's see here. We got a lot of folks checking in here, guys. Good to have you. But let me just talk about what the word is, what we got today. And I didn't really go into detail with it, but I'm going to go into detail a little bit about it. We got word from the FOMC, Federal Open Market Committee, right? That's the arm of the Federal Reserve that makes the decisions about whether or not they're going to increase rates or not increase rates, right? Fed funds rates, right? They decided today to hold interest rates steady. They have a 2-day meeting 8 times a year. And at the conclusion of the second day, the chair, Jerome Powell, he comes out and has his press conference, which I mentioned earlier that I listened to, right? So they came out today and said, we're not going to raise rates. Of course, they haven't raised rates in many months. And he said, we're not going to cut rates. Some people were expecting a rate cut. This is the balancing act that the Fed has to sort of play. Now, as an investor, all of us pretty much on this live feed, we're all retail investors, right? We're not big institutional investors, right? As a retail investor, here's what you need to be thinking about and some things that you probably want to ask yourself. What was the verdict for you as an investor in the stock market? I don't care if you have a 401k, a 403a, a 403b. I don't care if you have a TSP plan with the federal government. Doesn't matter what you have. I don't care if you have individual stocks that you just invest in to play around with and have some fun with. But as an investor, this is why this stuff is important to us. And this is why I want to talk about it on this channel. These are things that you need to be thinking about and asking yourself based on what you hear and what the Fed does with the federal fund, with the Fed funds rate, right? So when you listen to what the Fed Chair Jerome Powell said and says, what he says and how he says it sways markets, right? Exactly what he says and how he decides to deliver it, it actually has the opportunity to sway the market one way or the other. Now, the Fed knows this, right? So they're very careful about what they say and how they say it and how many times they repeat it and what's in the script and what's not in the script. Okay? Thanks so much, Miss Shipu. I appreciate the super chat. I appreciate you for this amazing channel. Thank you for all you do. God bless. God bless right back at you. I appreciate you as well for checking in and being here. And I appreciate that super chat, by the way. So what the Fed Chair Jerome Powell did was, or what you want to be listening for is, does he indicate that rates, the Fed funds rate, when we talk about rates, we're talking Fed funds rate, did he indicate that rates will probably fall but at the next meeting? They meet again. The FOMC, they meet again in March. So did he give an indication to us that they would actually lower rates or keep rates the same at the March meeting, the next meeting, right? So he sort of indicated that rates are probably going to fall after March. So as an investor, this kind of told me that the Fed is sort of waiting to see, because he gave a lot of language regarding we're kind of waiting around. We're kind of trying to see what we're doing. We're not quite sure. He kind of gave very, as I said earlier, timid, weak responses to some of the questions that were asked. He's on the fence a lot always, right? But he was really on the fence today more so than he had been in the last, 7-8 meetings or so, 7-8 press conferences. So that gave me an indication as an investor that they're sort of looking or waiting for perhaps another indicator, right, to maybe fall. And I'm thinking to myself, maybe that indicator could be perhaps the housing measure, right? Again, remember, the core PCE is down to 1.9% year over year. And so if it's down to 1.9%, but housing makes up a large percentage of that, and housing is up is at 5.7%, that tells me that housing is being really, really stubborn right now. And I'm wondering, is the Fed looking for maybe that indicator along with some other indicators before they make the decision to start cutting the rates, right? Because they've left them kind of flat for the last meeting or so, and last couple of meetings, and now there's an indication that they may leave it flat again in March based on how he answered some questions, right? So it's something to think about in terms of, as an investor, and I'll talk about what this means in terms of stock market in just a moment, but March, he indicated that March would be too soon to make a decision whether or not to cut rates again or not. So that's sort of an indicator. Again, we're looking what people do, what investors do, especially large investors, the institutional investors, right? Right, the hedge funds, the pension funds, they're looking for these indicators in his speech, in what he says. So I believe, based on what I heard, that the Fed likely won't touch rates again in March, right? Based on what he said and how he said it, right? Now, the other thing as an investor that we want to be looking at is, did he give an indication of how soon they would cut? Sort of the same thing, right? But as a retail investor, okay, let me go back and say this. Institutional investors, they priced in, before this meeting today, they priced in the fact that they priced into the market. They priced into the market that they would see about 5 cuts this year from the Fed, right? Now, big investors, they make huge stock market decisions, right, based on what he says, right? And so after the meeting, right, there was a 60% chance that the Fed would be cutting when the March meeting came around, the Fed would be cutting rates. Well, just shortly after the meeting that he gave his speech today, just shortly after that, that probability went from 60% down to about 38%, just in a matter of, an hour after his speech. So I share that with you because a lot of folks don't realize that as an investor in the stock market, what the Fed says and how he says it is very, very huge, right? And so they build these probabilities into the Fed's next move, into what they do in the stock market in terms of their own business or what have you. So institutional investors, and I'm trying to pass this along to us as retail investors. Institutional investors are trying to look for indicators to make moves in the stock market before the next day gets here, right? They're trying to figure out what's the best way to make a move in the market or markets before that time comes, right? So they build in these probabilities to how they actually are acting with the market right now. So there was a 60% chance that, the Fed will probably cut rates in March. Now there's only a 38% chance that the Fed will cut the Fed funds rate in March. And they did that all based on what he said, how he said it, how he answered questions when the questions came in after his 5 or 10 minute speech, right? So as a retail investor, we need to know, or we want to be paying attention to these types of things, right? Very, very important for us to be paying attention to what's going on. The next meeting's in March, right? There's 8 meetings throughout the year. And now institutional investors are saying, you know what? The Fed probably won't cut rates in March. So let's move in this direction, or let's move in that direction in terms of how we handle the market. As a retail investor, if we're listening to the Fed and listening to what the Fed says, we can be doing the same types of things. If that makes any sense, right, guys? We can kind of be making moves in the stock market in a way that puts us kind of ahead a little bit. Of course, there's speculation. Of course, there's risk. Now, that's if you invest in individual stocks, right? On this channel, I kind of like to talk to both folks, right? We got people that do play the individual stock game, but we have a lot of folks who play the game that I recommend for most retail investors. And that is the ETFs, the index funds. The ETFs, the index funds that are dollar cost averaged into, right? So something to keep in mind. Just want to kind of throw that out there. The other thing as an investor that we should be keeping in mind is what's going on with the rest of the economy around us, not just what the Fed is doing with the Fed funds rate. What's going on with the unemployment rate, right? What's going on with the GDP, right? We heard last week, a week and a half ago or so, GDP, we got the advanced numbers for December, right? The advanced numbers for GDP, which measures the growth in the economy, was at 3.3%. I say advanced because, again, as I talked about on my last video, guys, or last live we did last week, we get 3 readings from every single quarter. We got the advanced reading for fourth quarter of 2023 in January. We'll get another reading in February, and then we'll get the final reading of fourth quarter in March, right? So we got the advanced numbers from quarter 4 that said GDP was up 3.3%. Wonderful. Strong economy, right? As an investor, a retail investor, we should be knowing that, right? And so that's why on this channel, I come on here and I talk about things because I want you guys to actually be kind of, hip to what's going on. So you're not really like in the dust and you got all this money invested in the stock market. You got some of you are sitting here on this live and you got hundreds and hundreds and hundreds of thousands of dollars in the stock market. Well, if you got hundreds of thousands of dollars in anything, you better know what's going on, right? At least be knowledgeable. And that's kind of what I try to bring to you guys when we have these talks about the U.S. economy. Now, the stock market, as a retail investor, we need to also know that the stock market reacts to every time the Fed has one of these meetings and the Fed Chair Jerome Powell comes out and gives his information on what the FOMC is going to do. The stock market reacts. Right? Because again, large institutional investors are paying attention, and so they move accordingly. And sometimes as a ton of them move accordingly, that affects the stock market, right? So if you're just a regular retail investor like me and 99% of you on this chat, we make money or we lose money based on everything I've said in this live so far. We make money and we lose money based on those things. If we want to truly understand our money, yes, we need to know how to manage our money. Yes, we need to know how to do a budget. Yes, we need to know how to take this depreciating thing called cash and move it over to appreciating things like stocks, like real estate, right? We need to know these basic things, right? But we also got to know what is happening in the larger, sort of what they call macro, idea of money in America, right? So we need to know the basics, but we also got to know some of this larger picture stuff. And that's kind of what I like to bring to you guys. That's why this larger picture stuff matters to us, because it's going to affect, we're going to either lose money or we're going to make money based on how the market reacts to what the Fed decides to do with the Fed funds rate, right? The stock market's going to fluctuate up or down based on some of the things that was said today, some of the things that took place today, right? So now, what's going on, right? How should we respond to news that the federal funds rate stays the same or that the federal funds rate got increased or decreased? It stayed the same today. But here's what I like to explain to you guys. As regular retail investors, chill out. Relax. Don't get too hyped and don't get too down about what you see taking place in the stock market, right? Pull back on some of the emotion, right? Because you're going to turn on Bloomberg News or watch whatever you watch on TV or YouTube or what have you. and you're going to see breaking news, stock market this, stock market that. Sometimes they'll even make it really fancy. They'll put ticker all at the bottom of the screen, right? Put it in red so they make sure it catches your attention, right? But I'm telling you, as a retail investor, you have to take the emotion out of the investing. Don't get too hyped. Don't get too low. Like last week when everything went up, stock market at all-time highs. Don't get too hyped. Just do what I say, like play the game like Tim Duncan plays basketball, right? Tim Duncan, famous NBA player. Never gets too hyped, never gets too low. Always in the middle, right? As an investor, that's where we should be. Whether the market acts negatively to what the Fed does or whether it acts positively to what the Fed does, if you're a long-term investor, what happens on these day-to-days won't affect you as much, right? Won't affect you as much if you are a long-term investor, which I try to get people to be on this channel. I don't talk about day trading on this channel, right? I don't talk about get rich quick on this channel. I don't talk about how you can make $10,000 in the next week on this channel, right? As I always say, I don't have a course to sell you. I don't have anything to sell you on this channel. I'm just giving you information because I think it's important that people that deal with money every single day, which all of us do, that we have as much information as we can to make the right decisions with our money. So in my opinion, here's how you handle all the information. Unemployment rate is super duper low. Great, right? I've been under 4% for the last, 26 months, I think. Unemployment's been under 4%, right? Unemployment is low. Housing inflation is high. The housing market is a whole nother animal. But also the actual Fed funds rate being stuck on 5.25% to 5.5%, not lowered just yet. Money is still fairly expensive to borrow, right? How do we handle it as the regular, average, everyday investor, right? Stick to the basics. Stick to the basics of long-term investing, even when you see these things taking place in the markets all around you, right? What are the basics? Now, I talk about the basics quite a bit on this channel. What are the basics, right? The basics are pretty much 7 things, and I'll pull them up because I don't want to have to memorize them like I've memorized everything else. My brain is getting pretty fried here. All right. So the basics for retail investors that don't want to get too hyped, don't want to get too low, but we also want to make sure we take advantage, right, of some of the dips that we see. We're paying attention. I always say this. You need to have an investment strategy, right? You need to have a sort of a plan in terms of investing. What do you plan to do? And that plan that you have in terms of investing always starts with your long-term goals with your money, right? These are the basics. The second thing, after you have an investment strategy or a plan, the second thing is to make sure that you are being consistent with investing. And when I say consistent, I mean dollar cost averaging, as I said before, DCA, right? Dollar cost averaging just means taking $200 every 2 weeks, put it in the market. No matter if the market's high, when the market gets high, you don't have to increase or decrease what you're putting in. If the market gets low, you don't have to change your investment amount. Same amount the whole time. $200. That's all you do. It could be more. It could be $600. Could be $1,000. Could be $50, right? Same amount at the same interval for a long, long time. That's dollar cost averaging, just consistency over a long time. That's it. That's the second thing. The third thing that I would advise you to do, based on what you heard today, what you may have not heard, is obviously anytime you invest, know what you're investing in. Don't listen to me to tell you what to invest in, right? You make sure that you know what it is that you're investing in. Again, we're sticking to the basics, right? Before I get to the rest of the basics, let me just kind of run through these chats here, guys. And sometimes I like to look at the chats and sometimes I don't. Please, guys, do me a favor. Smash the like button for me. That helps this channel or helps this video get out to more and more people, which is what we want to do, guys. This is real sort of, I like to call this, I don't know how you guys would describe this channel, but it's real basic practical, common sense things to do with your money. That's really all it is. And so we want this to get out to more and more people. So share this link. And if you're not a subscriber to my YouTube channel, please feel free to subscribe. Really would appreciate that. Yeah, somebody said Tesla's down 25%. They're down. They're probably going to be okay. But some of the tech stocks were really huge. You know, what they call the Mag 7, right? They were really huge in 2023. And, you know, just never know. I want you guys to think about something, though. Since we're talking about Tesla, it's in that Mag 7 or top 10 in the S&P. I want you guys to think about this. I'm a big fan of index funds, not ETFs. One of the main reasons is because ETFs and index funds, it takes the guesswork out of investing in the stock market, right? When you're investing in individual stocks, like an individual shares of Tesla, you need to know what Tesla's earnings report is telling you about the future of Tesla. You need to know what Tesla's 10Q and 10Ks say about the future of Tesla. You need to know what their profit loss statement looks like. And so if you're going to be doing your individual stock market investing the right way, you need to be doing your research on all the individual companies that you decide to actually invest in or not invest in. The thing about, and that's with individual stocks, the thing about index funds and ETFs and why I like them so much better, because it takes some of that guesswork out of it. You don't have to, if I want to invest in the S&P as an index, because the S&P 500 is an index, if I wanted to invest in that index, I don't have to research all 506 companies or all 507 companies. I just got to research the index, see how the index has done. It takes all that individual company guesswork out of it. I don't have to go read 10Qs and 10Ks. I don't have to go read earnings reports, right? I don't have to do that. That's one reason I don't like to do in individual stocks. They're fun to play in, right? But for the most part, I talk about ETFs and index funds. That's just one reason. So I had to throw that in there, guys. Let's see. I'm thinking about shorting Meta, $8 to fill. Let's see. DCA into ETFs, paying attention at work. Absolutely, Kathy. DCA into ETFs and keep life simple, right? Thanks for smashing that like button, Corey. I appreciate you being here, Corey. Let's see here. Park temporary funds and high yield CDs or high yield treasury bonds. That's cool. Nothing wrong with that strategy as well. Somebody said get metals, right? Nothing wrong with that. If that's what you choose and you know metals, right? Don't get into metals, right? Don't get into gold and silver if you don't know gold and silver, right? Now, if you want to get in gold and silver, then go learn about it before you put your money there, right? Let's see. Somebody said my plan is to buy Walmart prior to a split. Just looking to see if you guys got any questions in here. China, Russia. Okay, why do you prefer index funds over ETFs? Vaughn said, why do I prefer index funds over ETFs? They're pretty much one and the same. I prefer both, right? I prefer ETFs and index funds. There's a few differences in terms of tax differences between the two, but ETFs fluctuate throughout the day, right? Their price can go from $200 per share to $205 per share in price in the outset of a day, whereas index funds, one price. So I like them both, right? I like them both. I have no preference of an ETF over index funds. ETFs just typically, a lot of times with ETFs, there's a lower barrier to entry for an ETF. There's some Vanguard index funds that have a minimum where you need $3,000 before you can even invest in this. You might need $100,000 minimum to invest in that. So ETFs are a little bit easier to get into. JT Coin Rings, good to have you here, man. Said, I'm always learning from your channel. I appreciate you being here as always. Thank you so much. Somebody said, my aunt in her late 50s and thinks she's too old. You're not too old. You're never too old. Late 50s, you might live to be late 80s. That's 30 years. From the age of 57 to 87 is 30 years. That's a long time. Late 50s is still young. Hey, 57 is the new 32, right? Basically. So you got a long time to go. Tell your aunt to watch this video and tell her I can give her as much motivation as she needs to keep it going and to get started if she wants. Somebody said fiat money is going down the drain. You must see this surely. CBDs are coming. Maybe. I don't know. I'm not a CBD investor. I'm not a CBD guy where I have a few videos I've talked about them, but I think it'll be a little while before they get here. And when they do get here, it's going to be interesting. Let's see. What pressure do you think the election year will have on lowering rates? Great question. I think the election year will have a. I don't know if you guys know this, by the way. I'll tell you this real quick. Good question. Who asked that? Steve. Did you guys know that like 4 billion people are this 2024 is like one of the largest, I think the largest election year in the world of all time of recorded history, right? There's never been this many, presidents and legislation, all this ever in the world. They said 60%, I think it was 60% of all people on the planet are going to be affected by elections this year. So, of course, there's a lot of other things going on throughout the world as well. But I think elections will play a role. And that's, to be honest with you, as the Fed guys, the Fed plays a tricky role, right? The Fed has to be careful because what will happen is if the Fed starts lowering rates around the time of, June, July, October, then people are going to say, yeah, the Fed is working with this party or that party, right? So the Fed has to be careful about that as they still maintain their policy. I'm sure they're not thinking about that, right? It's not part of their policy. They just have their dual mandate. But yes, I think there will be an effect on rates due to the election. And I think it will have a lower, I think it'll have I won't say the Fed funds rate, but I think it'll affect the stock market. Let me put it like that. It will affect the stock market. Typically, in an election year, the stock market does a little bit less. It doesn't do as good. Okay, typically, the year before a major presidential election in America, the year before, stock markets are usually up. The year of an election, a presidential election in America, the stock market is down a little bit. Not down, but just down a little bit from where it was the year before presidential elections. That's kind of what the history tells us about that. Let's see here. Christopher said, disconnect your emotions from the market. It's down today, and I see it as a chance to buy in my portfolio at a cheaper price. Good job, Christopher. Market goes down, begin to take that opportunity to buy. But again, if you're buying individual stocks or if you're buying ETFs or whatever, you can buy more shares when it goes down, what have you. But but less emotion, right? Money itself, I always talk about personal finances on this channel. So let me say this. Money itself you need to remove emotion from money and try to use logic. Money is amoral. Money's not good. Money's not bad. It's whatever you decide to do with it. So when you're dealing with money, managing your own personal money, managing your own personal portfolio, try to take the emotion out of the money and just try to think logical with money, right? Where people mess up in investing, I'm getting loud, I think. When people mess up, I talk loud sometimes. When people mess up with money or investing their money, it's a lot of times because they get emotional with it, right? Oh my gosh, I'm scared. I'm fearful. Let me go make a move in the market. Oh my gosh, I'm so happy, right? I'm emotional, but I'm happy. Let me go make a move in the market, right? And the thing about the market is this: you buy low and you hold, or you buy low and you sell high. But what happens to people is they get emotional. Oh, the market is up last week. Wow, I'm going to buy. And they buy high. Oh, the market went down this week. Man, I need to sell. They buy high and they sell low because they got emotion wrapped up into investing. Take the emotion out. Remember, buy low, hold, or buy low and sell high. Just like I did on eBay, for many years, right? I would buy a pair of shoes for $4 from an estate sale or a Goodwill sale. And then I'd take that shoe, get it ready, boom, boom, looks good. I'd sell it for high. The stock market is the exact same way. But when you get emotion involved, you begin to flip the script on that. You got to be very, very careful about that as a retail investor. And yes, I keep calling us retail investors because we're not huge. We're not playing with 10 and 30 and $50 million and $500 million, right? All right, let's see here. Sorry about that. I get on a tangent here. Let's see here. Late to the Q&A, Crafty Librarian. What we talked about early, Crafty Librarian, we talked about the Fed's, what the Fed has done in terms of keeping rates the same and not lowering them and not raising them this time around, right? And so basically what the Fed has done has worked. They could pretty much drop the mic if they wanted to, right? Still some housing lag in terms of housing inflation because we know rents are still high. So I started telling you guys about what we should do as retail investors. So I got to number one, I think, was have a plan. Number two was consistency over time, dollar cost averaging. Number three is invest in what you understand. Number four is this: always risk what you can afford to lose, and never, ever, ever discount risk when you're investing your money. Always account for risk when you're investing. Okay. With regard to what happened today, we should be knowing what's happened today because maybe it'll help us mitigate our risk in terms of the next 3 or 4 weeks in terms of investing. That's why we want to know what happened today with the Fed and how the stock market reacted to it, because now it helps us plan for risk coming up in how we're deciding. So I want us as retail investors to almost be thinking like institutional investors, so we can make better moves in terms of the stock market. And so if you're playing the game where you want to actually do some individual stock investing, or if you're playing the game where you want to buy and sell ETFs, right, shares and so forth, you need to be listening to what's taking place in the market, right? The fifth thing you want to do, and I got 7 of these, but 5 things that we still want to do, the basics, is make sure you diversify your investment choices, right? Diversify your investment choices. Right? Now, I said this before, guys. You don't need a broad-based index fund from Fidelity and then go buy a broad-based index fund for the entire market at Vanguard and then go to Schwab and you're buying the same thing on top of each other, right? What they call overlap. You don't need to do all that. When I say diversify your investment choices, maybe not have everything wrapped up into Tesla. Don't have everything wrapped up into just Apple and Microsoft. That's your two stocks you invest in. All right. As much as we preach about diversify your investment choices, you would be shocked at how many people only have money in 1 or 2 individual stocks. A lot of people do that. I don't know why they do it, but a lot of people do it. They've seen something on the internet and they say, "Oh man, Apple, let me go buy Apple." And all they have in their portfolio is Apple. Okay, don't do that. Diversify what you have, and that's why when I buy, ETFs, and that's why I like ETFs and index funds, because it spreads around my risk, right? Because if I have the S&P 500 as an index fund, then guess what? I own 500 companies in my bucket, not just one. And so now, if one of those companies, like Tesla, has a bad quarter, right? Bad earnings report, goes down by 25, 30%. It's not affecting all the other 499 companies I have in my bucket. So you want to spread around your diversity, right? Number 6 is this: if you get dividends, I like to always reinvest dividends, right? I love to reinvest the dividends, guys. And then finally, number 7 is just don't panic, right? Just don't panic, relax. Like I said earlier, even keel. Even keel. Let's see here. Let's go back to the chat here. What do you have more faith in regarding stability? Dow, NASDAQ, S&P. I'm an S&P guy. DS Thomas, I'm an S&P guy. Dow. Now the S&P, keep in mind about the S&P. If you invest in an index fund or ETF that's an S&P 500, keep in mind that it's a weighted index. Okay. Most people forget about this, but it's a weighted index. That means Tesla is maybe 5% or 7% of your investment, right? The Mag 7, Apple, Nvidia, those things are going to take up probably 29 or 30% of the S&P. Heavy on IT. S&P is heavy on IT, right? Meta and some of the others. But the point is that I'm an S&P guy, but I'm not discounting the Dow or the NASDAQ, okay? So I don't want to throw any shade at any of those as well, but just to say I like the S&P. The other thing that I think is very important for you guys to keep in mind as individual investors is this, guys. When you play that individual stock market game, that's what you like to do and you love to look at it and it's fun and all that. Great. Just remember this though. The top 10 companies in the year 2004 are totally different than the top 10 companies in 2024. Not totally different. I think there's a few of them that are the same. But for the most part, you got a whole brand new crop of companies that are at the top that weren't at the top in 2004. So that means that in 2044, you're going to have a whole nother crop of 10 companies that are going to be leading the pack as far as the S&P, right? So that means if you're investing in individual stocks, you have to be the person that picks and chooses the optimum time to sell those stocks. Again, that's why I like index funds and ETFs, because I don't have to make that decision if I own ETFs or index funds. I don't have to make that decision. I'm just buying the S&P and it's tracking it. No matter what's in the bucket, it's just tracking what's in the bucket. But if you own them individually, you got to figure out when to sell, when not to sell, etc. It makes the job of investing much more difficult. And that's why index funds and ETFs beat individual investors for the most part, 90% of the time. You know, there's studies there that you can go look at and read on the internet. Let's see here. How does this? Okay. How does this sound? I live in Ireland, South, so it's 1 hour to North Ireland. So you change euros to sterling, but guess what? Now they want change more than 1,000. Not sure what you're saying there. Help me with that, Paul. I say, do you think we are in a major correction? I do think that stocks have been a little bit inflated. Let me just say it like that. I don't think it's a bubble in the market, but I think stocks have been a little bit inflated. We'll see what happens. I think we'll get a correction here soon, at least this year in 2024. Hey, all good to have you, Hunter from West Virginia. Appreciate you, Future Beauty, as well. Let's see here. Any books I recommend teaching kids about money? I got a 2 and a 4-year-old, no concept of money. I think if you got kids that young, Steve, 2 and 4, I think you just got to go to Barnes and Nobles or Amazon and see what they got. I would say that at 2 and 4, the best teacher is you right now, right? There's probably some books and so forth you can get. I don't know any children's literature that is going to really teach you at that age about money, but I think you can teach them about money pretty easily, right? Let them shadow you, everything you do, right? Everything you talk about. Teach them how to count and how to figure and how to save. One thing you can do with your 2 to 4-year-old, Steve, is teach them, do exercises with them to help them learn how to delay gratification. That's one of the best things. That's one of the best things you can do as a person, as a human being. It's one of the most important muscles that you can build up in your inside of you is delayed gratification, right? However, you can design little things around the house or what have you to help them work on delayed gratification. That's what I would suggest for a 2 and a 4-year-old when you're trying to teach them about money. Not just how to handle, the money itself, but how to actually save and delay gratification. If you can get that in your spirit at a young age, it's going to make you better with money at 15 years old and 20 years old and 40 years old. So good question, Steve. Let's see, Curtis. Let's see, preach it, Corey. Love the thanks, H.J. Bishop. I appreciate you. Let's see here. Hey, Maria, good to have you as always in the house. Glad to have you. Let's see here. I'm just trying to read through some of the questions here. Money market funds. Crafty said money market funds are considered fairly safe, right? You're going to get a much lower return on your money in money markets, okay? There's going to be some restrictions. Sometimes people like to hold their emergency money, and as opposed to being in a savings account or a high yield savings account, some people like to hold their money, their emergency money, in a money market, right? Where you're going to get a slightly higher percentage, but it's still going to be a very low percentage. Nothing wrong with holding, say, emergency money in a money market fund. I would not be investing my money in a money market fund because your return is going to be so low. Let's see, type of investment for beginners. Be great. A broad-based index fund or a broad-based ETF at a broker that you trust. A broker that you trust. Go to Charles Schwab's website. See if you trust them. Go to Fidelity's website. See if you like how it feels good. Go to Vanguard. I like Vanguard. Go to Vanguard's website and get on there and see how it feels and figure out which broker that you want to invest in, and then look for broad-based ETFs or broad-based, broad meaning large, meaning it's not just 30 funds, 30 stocks in the bucket, but there's hundreds of stocks in the bucket. I like the S&P as a good starting point for a brand new investor, right? Let's see here. Being 71 years old, you should invest in Roth before you retire. As for the long term, it has to build up retirement. Okay, check in. Hey, good to have you, Brandon, as always. Hey, trader from Nigeria, good to have you. So this is what we do, guys. We come on this channel. If you're new to this channel, we come on this channel at least twice a week, right? And twice a week, we talk money. Today, we're talking ETFs and index funds and what the Fed did in terms of, and what that means for us retail investors, right? Excuse me. But oftentimes, we'll talk about money management, right? We'll talk about budgeting. We'll talk about certain things specifically about how to grow your money. We might talk about side hustles and things that you can do to make more income and what to do with that income. We'll talk about how to think money, right? Because if you don't change your mindset, nothing else is going to change. You got to think differently with money, right? As opposed to how if you think the way you've always thought with money, you're going to get the same output with money. It all starts with how you think. So we talk a lot about that too, but we always talk about things to help the average regular person be empowered and get better with their money and have more money. Let's see here. He said, okay, they won't change. Delayed gratification is what separates us from animals. Absolutely. One thing that does, right? Piggy banks work for us. Keith, thanks for dropping that jewel in there for the other person that said, how can I help the 2 and 4 year? Keith said piggy banks work for us. And then when the small banks filled up, the small ones disappeared and bigger ones came in. That's an excellent point. That's what I did with my grandkids, right? We fill up a piggy bank, then we empty into a larger bank. Then we fill it up again and they understand how to do the change and so forth. So that's a good idea. Thanks, Keith, for adding that. I tell you, this channel has some of the smartest and brightest people that come into these chats and have conversations. So I appreciate you guys sharing information with each other. Nassau, Bahamas in the house. Good to have you. Let's see. Maria said, I keep my emergency savings in a money market account. Absolutely. That's a great place to put it. Hey, from Atlanta, TJ is in the house. Good to have you. Facebook, you said, interesting. Tell me what's interesting. So this is the deal, guys. The Fed today, Chair Jerome Powell, had an opportunity to basically drop the mic. Could have walked right in there and said, look, unemployment is still low. We kept part of our dual mandate that said we want maximum employment. Unemployment is still super duper low. Been under 4% for 26 straight months. Unemployment is low. Hey, guess what? GDP is growing. We ain't in no recession. GDP was 3.3% our first reading from fourth quarter 2023. GDP is up, right? At the same time, core PCE inflation, the one that we look at the most. By the way, the Fed looks closer at the core PCE than they look at the CPI or the headline inflation. The core PCE that we look at the most over 3 and 6 months, it's right around that 2%, 1.9%, and it's 2.9% annually. It's getting close and on an annual basis to be at our 2% target. Hey, we can drop the mic and walk right out. We're done. We're not going to raise rates this time. Boom. They didn't do that, though. They came in and answered questions with a lot of trepidation, a lot of teetering on the fence, a lot of I'm not really sure, a lot of, we're not really sure, right? We need more data. March may not be the right time for us. This is how they came in to the meeting. And I think part of the reason they did that is because they don't want to get overconfident, right? They don't want to get super duper confident. But guess what, guys? What the Fed has been doing is working. Now, where do we go from there as individual retail investors? What do we do, right? And I tried to lay out 7 things here that we should still be doing despite the fluctuations you're going to see in the stock market and despite what the Fed says and does with the Fed funds rate, right? Let's see. Somebody else said, first time on live. Jimmy John, good to have you, man. Good to have you. God bless you too, brother. Good to have you here. And thanks for checking in. Guys, smash that like button for me. Share this link with somebody else. Subscribe to my YouTube channel. If you're not a subscriber, I got a ton 500 plus videos or more, 400, 500 plus videos or more that talks about real estate, stock market, ETFs, money management, money mindset, all those things, guys. How to grow your money, income streams and side hustles and so forth, right? We hit it all at Smart Money Bro here on YouTube. So feel free to take a look at those. I have a 24 laws of money in the description box where I talk about 24 basic principles that help me build my wealth. I'm also in the description box. I put Mint Mobile down there, a link. I don't partner with very many people, guys, but I have partnered with Mint Mobile because they offer very, very good premium wireless services for excellent rates. Excellent rates. So I've got them and I like them. And I said, okay, let's partner. So we partnered. There's a link to that if you're interested in switching, and it doesn't take long. They do everything online and they have excellent customer service. So very good premium wireless services you want to check out as well. That's in the description box as well. I do one-on-ones where I talk to people. I always say that because personal finance is personal. Everybody's situation is different. I don't care if you're Black Panther AJ. I don't care if you're Paul Palmer. I don't care if you're Florida Real Estate. I don't care if you're Jimmy John or M Branch or Cardinal Russell, Maria, TJ. I don't care who you are. Everybody's situation is a little bit different, right? So I do one-on-ones to help folks with their individual money as well. Let's see here. I'm just running back through these chats. Talk with kids about money as they grow up. Absolutely. Always talk to them. How would that Fed news affect the stock market? I think the fact that the Fed kept it the same, it's not going to have an overly large effect on the stock market, but I think large institutional investors took note of the fact that the Fed kept it the same. They lowered their probability that the Fed would actually decrease rates in March. I don't think it's going to have a huge effect on the market right now. Okay. But I think it may. We'll see what happens. We don't know yet. We'll see, right? They just made the announcement today. Let's look and see what the market does tomorrow and Friday and so forth. And we'll have a better feel for the answer to that question. That all lies from Powell going to the Robinhood. Okay. Checking in from East Atlanta. Good to have you here. Let's see. Be great and fill up your emergency fund in a high yield short-term CD. Nothing wrong with that either, right? I always say, hey, I preach, hey, have an emergency fund, a fully funded emergency fund as soon as you can, right? Let's see. Somebody predicted USA will be in recession by November, 34 trillion in debt. Yes, 34 trillion in debt, never seen before. Could happen. We'll see what happens, guys. We just averted another possible government shutdown, and they're working on these budgets, and we'll see what happens. But yeah, 34 trillion in debt, guys. We got some issues in America, that's for sure. Everything is not as wonderful as it seems. There's definitely some issues, not to mention some of the geopolitical things that are going on around the world in terms of what's happening in Israel, what's happening over in the Ukraine, what's happening over in the Red Sea, right, with Yemen and so forth. All those things are going to they play a role, right? They may have a slight effect all put together on what happens in the markets as well. And those are things that we need to be keeping up with and understanding what's going on. I'm not saying you got to watch the news every single day because, frankly, I don't watch the news every single day. And when I watch the news, I typically only watch the financial news. But I do hear about these things and I do see what's going on a little bit because I do bring them to you guys. So I pay somewhat attention, but I don't get wrapped up into the emotion of because the news is a business, guys, right? And so, part of the business of the news is making sure is attention. Just like part of the business of doing a YouTube video is attention, right? You want people to attention is capital. That's why when you scroll through YouTube, you see a lot of clickbait. Don't worry. Oh, we're this, right? A lot of, warning, right? You see a lot of that type of stuff because people want attention, right? But again, as investors, don't panic. Stay stable. Go with the fundamentals. Stick to the basics, right? Let's see here. So, hey, I just wanted to share this video. I've been on here a little over an hour, guys. I appreciate you guys. Oh, somebody said, I got to answer this question. Hold on. Dave Ramsey or Robert Kiyosaki? You know what? I'm not a Robert Kiyosaki guy. I'm more, I don't agree with everything Dave Ramsey says, but I'm more of a Dave Ramsey guy. Not a big Robert Kiyosaki guy. Although I've read many of his books, right? With the signature purple, right? I've read many of his books because I like to read a lot of books that are, various points of view. I agree with some of the things that Kiyosaki definitely says, absolutely. But I would say I'm more of a Dave Ramsey guy, just to be honest. But I support all different types of folks, guys. If you come in this channel and you have a YouTube channel and you're a regular in here, I'm going to support you too, right? Because I want to get as much information out to people as possible. And I did a video recently that came out earlier today talking about, or it'll come out in a couple days, talking about be careful with the scammers. So you'll see that in a little bit. So, hey, I appreciate that tech. Let's see. The Fed will just print more money. Make sure eat and hydrate. Yeah, future beauty. Hey, listen, I appreciate you guys more than you know for being here and showing up. Again, I think this is the first time I've been on LinkedIn. If you're checking in from LinkedIn, give me a thumbs up. I appreciate you being here 2 to 3 times a week. Go over to the YouTube channel, subscribe to the channel, smash the like button. And if you're watching this on replay or you want to rewind this back to the beginning so we can get exactly what the Fed did today, please ask a question, drop a comment. I'm more than likely, especially on these lives, I try to answer all of the questions. I'm going to be back on here tomorrow, guys, at 4:30. Once I finish up my regular job, I'm going to be back on here at 4:30 tomorrow, and we're going to be digging deep into another money topic. All right, so join me again tomorrow, same time, 4:30 p.m. Central Standard Time. Be back on here to bring some more information to help you guys with your personal finances. All right? Hey, the best person who's going to take care of the old you is the young you. Guys, do me a favor, take good care of yourself and take care of other people. Until the next video, peace.